Good, good afternoon and welcome all the participants for the WOW series. And today's topic is the GST ITC. Before starting our webinar, I request you all to put your right hand on your heart for our institute motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you, Ms. Raji. This year I am a committee chairman of Women Empowerment and Young Member Committee, and I am also the chairperson of Vikasa for the year 23-24. And to brief you all, I want to tell you that we had celebrated the Wonderful Women Week this year. Because we thought that why Women Day we are celebrating only one day. We should celebrate a week. So from 3rd March to till 11th March, we had celebrated the Wonderful Women Week, and we had given name WWW and WIRC. And we had several programs across the region. So in Maharashtra, Gujarat, Goa, and all the states and all the branches participated very well. All the study circles also had participated, and more than 500 women connected because of this program. So I want to thank all the female who had joined that programs, and we are doing this WOW series once in a month, one Wednesday. So WOW series in full form is Women on Wednesday. So that's I want to inform you all. And we have our learned speaker, CA Nivedita Agarwal with us to tell about the GST ITC, because right now it's a year end. We have to do the year end work also for to finalization of books of account for the 31st March 2023. So we should see that how we can deal with the ITC part. It's cumbersome and very technical things. कि ITC 2A का लेना है, 2B का लेना है, then what will happen if we had not paid within 6 months, and all this. There are so many technical points which Nivedita will discuss with you. And apart from that, if you have any question, you can put in your question answer box. Nivedita, you will take in between, or you will like to take at the end of the session?
I would be happy to take in between if it is related to the topic that I'm speaking on.
Okay, so you will check yourself in Q&A, or Payal will ask you?
Either works, no problem.
Whatever you're comfortable with, ma'am.
Yeah, yes.
So
okay.
Whoever has a question can put it in the chat box so that we can see, and then we can, address it while we are speaking.
मिश्रा जी, वो ये लोग सब डाल सकते हैं क्या?
हाँ मैडम,
पार्टिसिपेंट चैट बॉक्स में भी डाल सकते हैं ना क्वेश्चन?
यस यस.
ओके, क्योंकि बहुत सारे टाइम में जूम मीटिंग में they are not allowed to put in the chat box. They are only in Q&A. They can put only a Q&A. So for this Zoom meeting, you all can put your question in chat box also and Q&A also. So Payal madam or Nivedita will take care of that questions. And if anything will left, they will take at the end of the session. So I formally want to thank Nivedita to accept our invitation for the today's program, and I want to introduce him formally with you all. Nivedita is specialized in indirect tax and is actively involved in GST advisory. And she has an experience of over 7 years, and she is currently associated with the consulting division of Lakshmi Kumaran and Sridharan, tax attorney in Mumbai. Nivedita handles several big clients in providing advice on strategy, operation, and optimization of tax benefit. And her client base comprises of some of the leading name across sectors such as metals, petroleum, FMCG, and insurance. She is expert in complete tax issues involving classification, valuation, ITC, eligibility, etc. And she is also handling the tax compliance review under tax assignment to provide efficient tax solution to her clients. Nivedita has numerous publications on wide range of topics in indirect tax, and her education is she is law graduate from Dr. Ambedkar College of Law, Vadala, and she is a CA also. So, with this brief introduction, I want you to invite Nivedita in our Zoom session of Wow series. So, Nivedita, thank you for accepting, and now you can start your session.
Thank you so much, Didi. Thank you. Welcome to my session. Please feel free to make the session interactive. Please feel free to put your question in the chat box while I'm speaking on a topic so that we can address it and I can also understand what you are looking for in my session. I've tried to take up more of legal aspects related to ITC since we are dealing with a lot of legal issues. The law firm that I'm working with, we are representing clients in High Court, Supreme Court, etc. So we really go into the nitty-gritty of issues. So I've tried to, give you legal and technical acumen to many of the issues that our clients are facing under ITC. So just with that introduction, I'll start my session. So is my screen visible?
Yes, ma'am.
Okay. Basically, I have chosen 8 topics that I will be speaking in the webinar today. The first topic that I would be speaking on is availment of ITC in case tax has not been deposited by the supplier. So we all know about Section 16(2)(c) of the CGST Act by now. What the government has done by introduction of this section is that they are saying that a recipient is allowed to avail input tax credit of the GST paid to the supplier only if and when the supplier makes payment of tax to the government. So, mere payment of tax by a recipient to a supplier is not sufficient. The government also wants to ensure that the tax is coming to the government kitty before they allow the recipient to avail the input tax credit. Now, this is not a new provision under GST. There were many state VAT acts under which similar provisions existed. Such provisions did not exist under the central excise or service tax regime, but learning from their past mistakes, it was not possible for the government to ensure or to check whether every supplier had paid the tax to the government. So they shifted this onus from themselves to the assessee, and they told the assessee, look, if you are taking supplies from a supplier, it is your job to ensure that he is a supplier in the system. He is not bogus or fake. He is actually intending to pay tax to the government. So only when he pays tax to the government will you be eligible for credit. Now, when they had brought in this provision, they had also envisaged a matching system on the system itself. So they had envisaged a very advanced GST portal where everything would be available on the portal, and the recipient could see on the portal whether the supplier had paid the tax or not. But in reality, that mechanism of GSTR1, GSTR2, and GSTR3 was never implemented, and as on date also, the recipient does not know whether the supplier has actually made payment of taxes to the government for which the recipient has paid the tax to the supplier. So while this provision may look very advantageous to the government and very ideal on paper as far as GST is concerned, but this provision is very difficult to implement. It is posing a great difficulty for the assessees, and even big Fortune 500 companies are really facing trouble as to how to comply with this provision. So there are twofold arguments that assessees are making with respect to this section. First, the very first argument that is being made, that the assessee or the purchaser is a bona fide purchaser. They have purchased the goods or services in good faith. They have made the payment of taxes to the supplier, and it is the supplier who is non-compliant. So, for the fault of the supplier, the recipients should not be faulted with, or the recipients should not be penalized. Therefore, recipients who have acted in good faith and done everything that they could should not be disallowed the input tax credit. That is number one. And the second argument that is being taken is that the fulfillment of this condition in the present system is impossible. The law cannot contemplate the recipient to do something which is impossible, because there is no mechanism that the law has provided for the recipient to know whether the supplier has paid the taxes on this to the government. Now, interestingly, there are more than 40 writ petitions that have been filed in different high courts across the country on this issue. So there are multiple writ petitions that are simultaneously being adjudicated in different parts of the country on this issue, and many people have challenged this, obviously, because it is a huge cost to the recipients who are not being able to avail the input tax credit. Not only this, the department is also using this section and is denying input tax credit left, right, and center for any and every situation. And department is not coming and simply issuing a show cause notice. They are doing investigations. They are almost resorting to threat, coercion, and they are saying that we will arrest, we will issue summons, we will do a provisional attachment of a bank account. So they are resorting to each and every mean possible to ensure that they get their money if supplier has not paid. Now, let us look at what are the legal material available on this. Firstly, there was a press release that was released on 4th May 2018, where it was said that just because there is a mismatch, or just because the supplier has not paid to the government, does not mean that there would be an automatic reversal that will be initiated on the buyer. First, recovery will be made from the supplier, and only if they are unable to recover from the supplier will they come after the recipient. So as per the press release, what is contemplated is that for the department or the government will first go after the supplier, and if they are not able to recover the tax from the supplier, then as an alternative measure they will come to the recipient. And it is only exceptional situations like missing dealer or closure of business, or where the dealer is not traceable, will this provision be invoked. So on a reading of this press release, it seems that the government understands that this is a draconian provision, and they do not intend or wish to apply in every situation. Then there was a subsequent press release on 18th October 2018. In this also they had clarified that this GSTR 1 and GSTR 2A are only a facilitation measure for the recipient, and it will not impact the availment of ITC. However, practically, obviously the reality is much different from what is written in the press release. Assessees are being harassed by the department. Now, let's go back to the VAT regime where analogous provisions, existed, and let's look at what the High Courts and the Supreme Court held in the erstwhile VAT regime. So, I would like to inform that there are several decisions of the Delhi High Court, of the Jharkhand High Court, of the Madras High Court. So there are several High Courts which have given a positive judgment in the pre-GST regime also, where they have said that a bona fide purchaser should not be denied input tax credit under VAT for the fault of the supplier. So this decision of Onquest Merchandising India Private Limited versus Government of NCT of Delhi, in this, the Delhi High Court has specifically held that the benefits of ITC cannot be denied to bona fide purchaser only because of default on the part of the seller dealer. and this measure is arbitrary, irrational, and unduly harsh, and violative of Article 14 of the Constitution. However, a negative judgment in this case has been passed by the Bombay High Court in Mahalakshmi Cotton Ginning pressing. In this case, they are saying that input tax credit is only a concession that is being given to the buyer, and the legislature can very well impose conditions to avail that input tax credit. So if there is a condition which has not been fulfilled, then buyer cannot take credit, and this condition is not lacking rationality. Here I would like to point out that the first decision that I had shown, this on-quest merchandising decision of the Delhi High Court, this has gone up to the Supreme Court and has been affirmed by the Supreme Court. Then there are other judgments of Punjab and Haryana High Court in Gherulal Balchand, Jharkhand High Court in Mrs. Tarapur and Company, and Madras High Court in Sri Rangawals, where everywhere a positive decision has been given, and it has been held that the input tax credit cannot be restricted to the buyer on account of failure of the seller. So this is all the legal jurisprudence pertaining to the pre-GST regime. Let us now see what is the legal position under GST as far as writ petitions which have already been adjudicated and final order has already been passed. So the first judgment here that I would like to point out is the judgment of the Madras High Court in the case of DY Bethel Enterprises. In this judgment also, though section 16(2)(c) was not struck down, but the Madras High Court specifically held that first amount has to be recovered from supplier, and if amount is not recoverable from supplier, only in that case can they come after the seller. So here they are saying that if you have not initiated any recovery proceedings against the seller, you cannot directly proceed against the buyer. So there is some sort of relief that is coming out of this judgment, because whenever section 16(2)(c) is invoked and input tax credit is denied, an SSC can say that, look, first you please go after the supplier, and in case you're not being able to go after the supplier, then you come after me. Then this is a very recent judgment, the second judgment that I'm referring to in case of Pinstar Automotive India Private Limited. I think this is come in 2023 itself. In this, the Madras High Court has also addressed that, look, if this provision is implemented in every case, that then the department could be enriched twice, or the department could benefit twice. The department could go after the supplier and the recipient and recover the tax from the supplier and credit from the recipient. So for one amount of tax, they would be getting from the supplier also and from the recipient also. So the Madras High Court has said that that should not be the intent, or that should not be the result of this provision. There has to be a mechanism that has to be put in place to ensure that the recipient is given back the credit if supplier pays the tax to the government. So basically what they are saying is that it is the substantive liability of the supplier and only protective liability of the purchaser. If amount is recovered from the supplier, then amount should be refunded to the purchaser. So let's see how this judgment will be implemented, because what would happen is the supplier is sitting in, say, Delhi, recipient is sitting in, say, in some other part of the country only, let's say Calcutta. So there is one government officer who's sitting in Delhi who's initiating recovery proceedings. Then there is another government officer sitting in Calcutta. They do not have any communication, or there is nothing between them. So how will it be figured out whether double benefit is flowing? How will they figure out a mechanism to actually refund taxes to the recipient? So this looks really good on paper. How it will be implemented is yet to be seen. So after all of this discussion, what our advice usually is that in case the supplier is not there in the system, that the supplier is a fugitive, the supplier has run away to some other country, or the supplier is not in the system anymore, etc., etc. In those cases, it is best that credit is reversed. And in other cases where the supplier is in the system, etc., then and GSTR1 has been filed, the amount is showing in 2B and all of that, then you should see whether you can file a writ petition, and you can fight out section 16(2)(c), etc. But section 16(2)(c) is not the only provision. As we move forward in our presentation, we will see that there are other sections that have also been introduced. So it is not like you can just fight section 16(2)(c) and get away with it. To strengthen section 16(2)(c), the government has also inserted other sections, which I will be speaking upon as we go forward in our slides. Is there any question by anyone?
Ma'am, one question in the question answer.
Question answer. In financial year 2019-20, assessee has availed and utilized the ITC. Okay. However, the same have been reflecting in GSTR 2A after October 2020. In this scenario, officer is saying to reverse the ITC and pay interest and penalty. But vendor has already paid GST via GSTR 3B. In this scenario, can we pay only interest? Also, do you have any case study regarding the same? So hi Shweta, to firstly answer your question, is this in the time period when rule 36(4) had already been inserted? Can you please unmute the mic of Shweta? Okay. So if rule 36(4) had already been inserted, I believe in 1920 the limit was 20%, 120%. So in 1920, as per rule 36(4), say if something was reflecting in GSTR 2A as 100, then up to 120 credit was being allowed. So I am of the view that as far as 1920 is concerned, even if only 100 was reflecting in your return, you could have taken that extra credit up to 20. So if this amount is coming in within that limit of 20, then even though section 16(2)(c) is existing, to give meaning to rule 36(4), credit should be allowed to you. You don't have to reverse your credit. In fact, you are not even required to pay interest and penalty. So you can have a look at rule 36(4) as it existed on the date on which this credit had been taken by you, because rule 36(4) has already was inserted at a later point of time, and that was amended. So from 20% they had gone to 10, and then they had gone to 5, and now it has come down to 0. So in your period, you can check what is the percentage that they had prescribed. If it is within the prescribed percentage, then as per rule 36(4), they should allow you the credit. Okay. Ma'am, if GST number suo motu cancelled of any supplier, then does it affect our ITC? If the supplier has paid the tax to the government, then it should not affect your ITC. If they have not paid the tax to the government, then we'll have to look and we'll have to determine on a case-to-case basis. So is this for a period before Rule 36(4) was inserted, Shweta? Okay, so there you are saying that there could be different scenarios. So if before 36(4), you could argue before, if let's consider that your situation is before 36(4), then in that case also you have a good case, like I was just showing. All the judgments of the pre-GST regime, you can rely on all those judgments and say that look, positive judgments are there in the pre-GST regime also. I have paid the tax correctly to the government. Credit should not be denied to me on the basis of all of these judgments because I am a bona fide buyer. So, and section 16(2)(c) is impossible to comply. Just one second. there is also one circular that has come out, Circular 183, that has come out on 27 December 2022. You can look at this circular also. This circular may also help you. This circular is saying that in situations, where payment has been made by the supplier, but the invoice is not reflecting in GSTR 2A of the recipient because GSTR 1 has not been filed. In those cases, for the financial year 2017-18 and financial year 2018-19, input tax credit will be allowed provided all other conditions are being fulfilled, and certificate from CA is taken if amount is above 5 lakh, or a self certificate is given if amount is below 5 lakh. So, there could be many different situations. You'll have to look at every situation. If it is after introduction of Rule 36(4), if it is before introduction of Rule 36(4), if amount is reflecting in GSTR 1 or if amount is not reflecting in GSTR 1. So there could be a situation where 1 is filed but 3B is not filed. There could be a situation where 3B is filed but 1 is not filed. So, if for every situation, answer would vary by a little. But by and large, before introduction of Rule 36(4), my view is that you should definitely fight out the credit for the entire amount, no matter what is the upper cap. You should say that there were lots of judgments in the pre-GST regime. I have act bona fide. There was no system for me to verify the credit, etc. So I should be allowed. And if it is a case, yes, this circular 183 is only for financial year 17-18 and 18-19. It is specifically written in that circular also that says this circular cannot be applied for other years. But after this circular was issued, it is very interesting that the Karnataka High Court, in the case of Wipro, has extended the circular to financial year 19-20 also in the interest of justice. So they have not really given any reason. They are only saying that in the interest of justice, this circular should, be applied to 19-20 also. Sure, you can give me your email ID. I will share the judgment after the session. Or I would be sharing my phone number and email ID at the end of the session. You can email to me. I will send you the circular. So, yes. So, before introduction of Rule 36(4), you should definitely argue. After introduction of Rule 36(4), whatever the limit was prescribed, irrespective of fulfillment of Section 16(2)(c), up to the limit prescribed under 36(4), you should argue. And now, on today's day, let me move forward in the presentation. There are other aspects that have also been introduced. There are other provisions that have also been introduced. So we will analyze that also. And on today's date, what is to be done, we will see. Okay. So can I move forward?
Yes, ma'am.
Okay, sure. So the next topic that I'm picking up is burden of proof for availing ITC. So this is a concept, which would not have been harped upon that much by other professionals. This is something that the department has also not really, been insisting so far. So let's see what happens. So a very interesting judgment has recently come out in 2023 by the Supreme Court. This is a judgment in the case of the state of Karnataka versus Ecom Gill Coffee Trading Private Limited. This judgment has been pronounced by the Supreme Court under the erstwhile Karnataka VAT Act. But because we have similar provisions in the GST Act also, I have picked up this judgment because this would have wide ramifications if the department, starts using this provision. So before delving into the judgment, I would like to, show Section 155. So Section 155 of the CGST Act says that for the availment of ITC, the burden of proof is on the recipient of the credit. I'll read out the exact section also. 1 second. So the exact section 155 says that where any person claims that he is eligible for input tax credit under this act, the burden of proving such claim shall lie on such person. So if I want to take credit, I have to prove that this credit is eligible to me. Now, what does this really mean? Let's look at the Supreme Court judgment to understand this better. What was happening in this case was that the supplier had purchased some goods from the supplier. The buyer had purchased some goods from a seller. Now, the buyer had invoices, valid invoices under the erstwhile act. The buyer also had checks. So the buyer had proof of checks. So the buyer was showing that payment had been made by the buyer to the seller. What the buyer was contending is that, look, I am a bona fide purchaser. I have invoices under VAT. I have made payment to the supplier. I have proof of payment. So therefore, I am discharging my burden of proof, and you cannot deny me the credit. The court said that no, this is not sufficient. This could be a web of fake transaction where there is this paper trading of invoices and payment, but actually the transaction is not has not taken place. So not only do you have to show your invoice and your proof of payment, but you also have to show that the transaction is valid, authentic, the transaction has actually taken place, the goods have actually moved. So not only these two documents, but you have to show the name and address of the seller, the number of the vehicle in which the goods have moved from the seller to the recipient, then the goods receipt note, then proof of payment of freight. So in case the department doubts that this transaction has not taken place, then this is just a paper transaction where goods have actually not been received, then you need to show all of these documents to prove that the credit is eligible to you. So Supreme Court has held that the department is correct in this judgment. The department is correct in their contention. The Supreme Court has held that in this case, burden of proof has not been discharged by the recipient because they have not shown the other proofs. They have only shown their invoices and they have only shown their checks. And therefore, they have denied the credit to the recipient. So this judgment is very, very, very important because this judgment may set precedents, and wherever the department wants to harass, the department can come after a buyer and now say under GST also that show me X, Y, Z documents, and if you cannot show me this document, then credit will be denied to you. So so it really we really do not know how this judgment will be used in the GST regime, but are the assessees expected to keep a paper trail of the entire transaction now, of all the freight charges that are being paid, of all the vehicle numbers that are being used? Though we have the concept of e-way bill, etc. under GST, so things become slightly more easy, but still, this judgment can be used to the detriment of the assessees in a big way. Secondly, the other thing that I also want to point out is that in the course of the arguments before the Supreme Court, they had also relied on the judgment of Onquest, which I had referred earlier, and they had said that in Onquest, the government has specifically held that the recipient cannot be denied the credit for which tax is not being paid to the government. But the court has held that this issue under Onquest and the issue under uh, Ecom Gill is different, because Onquest was on the payment of tax by the supplier to the government, whereas Ecom Gill is on burden of proof of the transaction to show that the transaction is not a fake transaction. So these two judgments have to be read in isolation. That judgment is on one aspect of the law, and this judgment is on the other aspect of the law. This judgment is not really dealing with situations where tax has not been paid to the government. So what will happen? So this judgment is there. This judgment may have wide ramifications. We have to see how the government is using this in Section 155. So far, we have not seen any case where the department has used Section 155 and they've come after the SSE. But we'll have to see how this moves. The other open question that also lies is that if an assessee is able to discharge the burden of proof, if the assessee is able to show all of its documents that it is able to show that the goods have actually moved, it is able to give proof of payment of freight to the transporter, if it is able to show that the transaction has really happened, Then, relying on this judgment, can we say that the requirement of section 16(2)(c) also stands fulfilled? Now we do not need to show whether the supplier has paid the tax to the government and therefore credit should be available. In my view, no. You have to discharge the burden of proof also, and additionally you also have to ensure that the supplier has paid tax to the government. So both the conditions have to be fulfilled for taking the credit. I know this makes life very tough for the chartered accountants as well as the assessee, but this is how the law has been drafted and this is how the law is being interpreted by the courts also. Is there any question on this? I believe that nobody has really faced the ire of this section yet, so nobody has any questions on this. But why the onus of proof is on buyer and not on seller? See, the buyer is taking the credit. It is the buyer who's benefiting, and they are saying, since you are benefiting, you have to prove. This is how they've designed the law. Now, how they have designed the GST law, they are just trying to say that you are taking the credit. You have to discharge all the functions to ensure that the credit has been paid to the government. So basically, I am the one who's benefiting. I am taking the credit. So they are saying that since you are taking the credit, you have to ensure that everything has been done properly, and I will catch hold of you. So in the pre-GST regime under excise and service tax, what was happening was that since they could not go after the buyer, they could only go after the seller. And if the seller became absconding, there were many situations where the buyer knew something like this was happening. The buyer knew that the buyer was actually colliding with the seller also. So to put a stop to all of this, where buyer cannot collide with the seller, the buyer also has to do due diligence. The department is saying it is not just our responsibility to ensure that everything is happening within the system. Since you are directly dealing with the seller, it is easy for you to know also whether the seller is paying tax, whether the seller is fraudulent, whether the seller is genuine, whether the seller is in the system, whether the transaction has actually taken place. So they have cast equal responsibility on the buyer also in GST. They've basically learned from their past mistakes. Is there any other judgment or case law also for the same issue? I believe there is no other Supreme Court judgment, but whether there is a lower court or a high court judgment, I'll have to check. Under GST, there is nothing, but under VAT, there is possibility that there would be other judgments also which have to be checked. Shall I move on to the next topic, or do we have any other questions on this topic? Okay, so I'll just move on to the next topic then. The next topic is reversal of ITC on non-payment of consideration within 180 days. I believe this is also one provision that every consultant and every company has come across. This provision has also been widely analyzed. It is impacting many SSCs and everybody is taking note of this provision. So before really delving upon this provision, I just like to read it out. Basically, this provision says that a registered person who has availed input tax credit on any inward supply, but fails to pay to the supplier the value plus the GST, then he will be liable to reverse the proportionate amount not paid to the supplier along with interest payable thereon. So basically, it is saying that supposing you have availed services worth ₹100 on which 18 rupees GST was paid, this 118 rupees has not been paid by you to the supplier for whatsoever reason, and 180 days are over. So you've almost taken 6 months but not yet paid to the supplier. In that cases, whatever credit you have availed, you have to reverse along with interest. Okay. Now, this provision comes under second proviso to section 16, and the attached rule to this section is rule 37. What was happening so far was that it was the section and the rule were not talking about proportionate reversals. So there were many situations where part payment was being made by the recipient to the supplier, only partial amount was not being paid. In those cases, there was a lot of confusion among the trade and industry whether the amount that is partially paid, for that will I be eligible to credit, or will I have to reverse the entire amount of credit along with interest. So to allay these fears and to provide a provision that is just and fair, they have amended the rule and they are saying that the reversal only has to be made proportionate to the amount that has not been paid to the supplier. So this is a beneficial amendment that has come and will definitely help the assessees. Here onwards, wherever partial payment has been made, reversal of credit should only be made for the amount that has not been paid to the supplier. Now let us look at situations and how this rule will impact different situations. Now let's say Mr. X applies to Mr. Y for INR 100 plus 18 being on account of GST. Now, on a combined reading of second proviso to section 16 with rule 37(1), what will happen in such situations? So there could be a situation where the recipient is only making payment of 80 towards the value instead of 100 and is paying the entire amount of GST of 18. Now this could happen on account of a commercial discount. So this is a post-sale discount. There could be a commercial negotiation between both the parties where the recipient says that due to this, you should give me a discount, or there could be many other reasons for which both the parties have agreed upon between themselves that only 80 is payable by the recipient to the supplier. In this case, whether the department can argue that 20 rupees has not been paid towards the value of services and therefore entire ITC of 18 rupees will not be eligible to the recipient, and as per second proviso to section 16, the recipient is required to reverse some amount of input tax credit. In my considered view, section 16(2) says where the recipient fails to pay. This is not a case of failure to pay. This is a case where we have both agreed that this amount is no longer payable. So when an amount is no longer payable, the question of failing does not arise at all and should not be insisted upon by the department, and credit should not be denied. Having said that, we know how the department works. They may not understand that this is not a case of failure to pay and the department may come after the assessees. In such cases, assessee has to litigate. Assessee can also rely on the judgment in AAAR judgment in the case of MRF tires, where they have recognized the concept of post-sale discount and they have said that in case of post-sale discount, only 80 plus 18 is payable, 100 is not payable at all. Second case could be 80 plus 18 where 20 has not been paid by the recipient to the supplier, not on account of any agreement with the supplier, but there is, let's say there is a dispute between me and the supplier. And I say that, look, you have only, the quality of good that you have supplied should only be worth 80. Or there could be some other dispute between us, or there could be some other reason. I am going bankrupt, I do not have enough liquidity, I do not have the amount to pay. I know I have to pay, but I'm not able to pay, so I've only partially paid. So in this case, there is some failure to pay and entire credit will not be eligible to the recipient. We understand and we know that 18 rupees that is pertaining to GST has entirely been paid. But since the entire amount of value has not been paid, in that cases, again, there could be an issue, there could be a problem, and entire credit may not be available to the recipient. There could be a third case, where it is not so well defined that how much. So the third case is that 80 rupees has been paid by the recipient to the supplier. Now it is not a well defined case and there is no breakup of the 80 rupees as to how much pertains to the value and how much pertains to the tax. And if you look at the commercial reality of transactions, nobody, when they're making partial payments, says that, okay, out of this amount, only this pertains to value, this pertains to tax. No. Everybody says 118 is payable, I have paid you 80. In those situations, how do you determine that how much amount of ITC is available to you and how much amount of ITC has to be reversed? In my view, in such cases, we should do a pro rata. We should bifurcate this 80 rupees between the value and the GST amount. To the extent of the GST amount, credit should be taken. For the remaining amount, credit cannot be taken, and if credit has been taken, that much amount should be reversed. So coming to the questions, ma'am, in some cases, the other party is supplier and customer also. Can we adjust the payment accordingly? So no GST reversal will be there. So I believe that Hemlata is talking about a book adjustment. So I had to pay him something, he had to pay me something. We have just adjusted in our books. So instead of me paying him 100 and then he paying me 100 back, yes, book adjustments are definitely allowed. Payment by way of book adjustment will also be considered to be payment. It is not a case of failure to pay. In commercial reality, it often happens that entries are set off. In fact, there are various judgments in the pre-GST regime by the tribunal also, which say that in case of book adjustment, payment has been made. So book adjustments very well allowed. In case of book adjustment, second proviso to section 16 will not be attracted. Mr. Atul has written, but they are issuing SCN. I'm not sure for what issue he's written this, but okay. So there is another issue under section 16, second proviso to section 16 that I wish to point out. The rule 37 is saying that interest is payable thereon under section 50. So the rule is talking about payment of interest under section 50. But if you look at the section so far was not prescribing any provision or any substantive provision under which interest was leviable. It is only under Finance Act 2023 where they've amended the section also, and they're saying that interest under section 50 will be levied. Now here, we are of the view that section 50 is the substantive section to levy interest. Any interest that is leviable under the whole of GST Act can only be levied under section 50. So if something is not flowing from section 50, even if under sub rule or under some other section they are saying interest will be leviable, that has to be under the contours of section 50. If it is not under the contours of section 50, that interest cannot be levied. Till now, the trade and industry was very confused as to whether how this interest would be leviable and whether the interest would be coming under section 50 only or not. By this amendment, it is very well clarified that this interest will also be levied under section 50 only. Now under section 50, interest is levied on input tax credit only in case of wrongful availment and utilization. So there have to be dual conditions to be fulfilled for interest to be levied. First, credit should be wrongly availed. Second, that wrongly availed credit should also be utilized. So if yours is the case where you have availed the credit, not paid to the supplier, 180 days have passed, but you have not utilized the credit stands accumulated in your books of accounts. In that case, you can argue that interest is not leviable under section 53 because utilization of credit has not happened. So we are of the view that interest under this section and this rule can also be levied only when there is utilization of the credit that had so been availed. I hope I've been able to explain myself to everybody. SCN for 180-day payment issue have been issued to many parties. Yes, so we understand that SCN has been issued to many parties. There are many practical issues that the trade and industry are facing. Like I explained from my examples, you can, you take the help of the examples and the explanation to my examples to, adjudicate, to file reply to the SCNs and to argue that some amount of credit should be available in cases where there have been a mutual consensus of non-payment, where there has been a post-sale discount which has mutually been agreed between both the parties. We are of the view that these SCNs are bad in law. Please do not reverse the ITC. You file, you litigate. Many big companies are also, facing these problems. judgments will come in your favor in due course, and there are judgments in the pre-GST regime also. There is one judgment of Hindustan Zinc, I think of 2011 or 2013, where also in that case some amount of uh, payment had not been given to the supplier on account of performance guarantee. So there was a contract between the supplier and the recipient. The recipient had to pay 1,000 rupees to the supplier. They had only paid 900 rupees. 100 had been retained by the recipient on account of performance guarantee, which was something that had been put in the contract itself between the supplier and the recipient. There, the tribunal has recognized that there is no failure to pay in this case. Contractually, both the parties have agreed that this payment will be made at a later point of date. This is not a case of failure to pay, and credit cannot be denied. So that kind of judgment can also be used to, fight for cases which are falling under second proviso to section 16. But ma'am, reversal of ITC is also not possible. I'm sorry, I really didn't understand what you're trying to say, Hemlata. Can you please explain a little more? Ma'am, it affects the ITC and working capital. So definitely, if credit is being denied, if you have to reverse the credit, then your working capital is getting blocked. You'll have to shell out more cash, which you could have, where you could have used ITC to make your payments. So all of those problems are definitely there. So cases where it is being alleged that complete payment has not been made to the supplier and therefore credit reversal is required, in all those cases you should very carefully and analyze that what kind of a situation is this, whether this really falls into the purview of failure to pay, and whether reversal of credit is really required. If there is no failure to pay, then no reversal of credit would be required. There is another question in the Q&A box. Any update on section 16.4 of CGST Act cases? So there is no significant judgment as far as section 16.4 of CGST Act is concerned. For benefit of everybody who's listening to me over here, section 16.4 provides the time limit for availment of input tax credit. Section 16.4 says that the time limit would be the 30th November following the end of the financial year to which the credit pertains, or the date of filing of annual return pertaining to the financial year, whichever is earlier. So basically section 16.4 is giving time limit within which credit has to be availed. There are no judgments on section 16.4 as of now by the high courts. Litigation has just picked up under the GST regime for 2017-18. In 2023, now SCNs are being issued. So SCN will be issued, assessee will fight, then commissioner will issue some order, then the matter will go to the tribunal. Tribunal is yet to be formed. We are hoping in 2023 the tribunal will come in. After that, matters will go to the tribunal. So, litigation is in a very nascent stage under GST right now. Only some high court writ petition judgments are there. Apart from that, there are no major judgments of the courts in GST as of now. So as of now, under section 16.4, no such judgment which should form a part of a landmark judgment or which can be referred by you. Okay, moving forward. So this is the next big Pandora's box that I'm going to touch upon. This is insertion of Rule 37A for reversal of ITC. So we already know and we already dwelled upon section 16.2C, which says that tax will be ITC will be available to the recipient only when output tax has been paid by the supplier to the government. So that was one section, but that section was not enough. That section was being challenged by assessees in various courts of law. Assessees were saying that, look, I do not know whether he has paid or not. You cannot deny the credit to me and this and that. So, but the department or the government is very resolute. The department is very sure. The government is very sure that in such cases they do not want to give the input tax credit to the recipient. So, to tackle this situation, the government, White Finance Act 2022, had substituted Section 41. The erstwhile Section 41 was based on provisional input tax credit. The new Section 41 that they substituted in Finance Act 2021, which further strengthened the Section 16(2)(c), said that every registered person, subject to conditions and restrictions as may be prescribed, be entitled to avail ITC as self-assessed in his return, and if this amount has not been paid by the supplier to the government, this ITC so availed has to be reversed. So Section 41 is saying that, okay, you have taken the credit, fine. Tomorrow you come to know, that the amount has not been paid to the government. You reverse the input tax credit, and when it is paid later, you take the credit again. So this provision had been put into place by Finance Act 2022, but this provision was saying that what will be the manner that will be prescribed. There was no prescription up to December 2022. In December 2022, they formulated the rule under this section, and they inserted Rule 37A in the CGST rules. So what this rule is essentially saying, I will read it very slowly so that you understand. The rule is saying that the supplier has filed Form GSTR1. Because he has filed GSTR1, it would be reflecting in the returns 2A, 2B also. Recipient has taken the credit in Form GSTR3B. But the supplier has not filed Form GSTR3B. Till 30th day of September, following the end of financial year in which credit had been availed by the recipient in their GSTR3B, then the amount of input tax credit so taken shall be reversed by the recipient in Form GSTR3B on or before the 30th day of November. To break this rule down further and to explain you in a more friendly manner, supposing supplier had made some supplies in January 2023, had filed his return in Form GSTR1, so it was reflecting in Form GSTR2B. Accordingly, in Feb 2023, recipient has taken the credit in Form GSTR3B. Okay. Now, supplier has not filed their Form GSTR3B till September 30th, 2023. So 30th September 2023 has come. Supplier has not filed their GSTR3B. In such cases, recipient is required to reverse the credit so taken on or before 30th day of November. So they are giving a period of 2 months to the recipient to analyze in what cases supplier has not filed Form GSTR3B and asking them to reverse. Also, it is to be noted that this reversal has to be made along with interest. So what the proviso is saying that, provided that where the said amount of input tax credit is not reversed by the registered person in Form GSTR3B on or before the 30th day of November, following the end of financial year, during which such credit has been availed, such amount shall be payable along with interest. And the second proviso is saying as and when it is paid, credit can be taken again. Now, maybe this rule looks really simple, but this rule is very complicated. There are many vague, the rule is drafted vaguely. There are many open questions that come to the mind of assessees. So this rule has only recently been inserted. Practical application of this rule has not begun. So many people would not have faced that many problems under this rule as of now. But come September 2023, everybody will struggle with this rule. So I'll just try to explain that what are the problems in this rule. First of all, as on date, the recipient only can see whether the supplier has filed a GSTR 3B or not. how much tax has been paid, whether the entire tax in GSTR1. So supposing a supplier shows 100 rupees in the GSTR1, but only pays 70 rupees through the GSTR3B. Recipients are not coming to know whether 100 has been paid through GSTR3B or 70 has been paid through GSTR3B. Recipients are only coming to know that the supplier has filed the GSTR3B. Partial payment of taxes being made, full payment of taxes being made, such details are not available to the recipient. Also, if a company is into business, the company is taking goods and services from hundreds and hundreds of people. This rule is putting an onus upon the recipient to check the filing status of GSTR 3B on part of defaulting suppliers. So, recipient has to go and check for each and every supplier. So, supposing there is a recipient, say that there is somebody called Hindustan Unilever. Hindustan Unilever may have 1 lakh vendors. Are they supposed to go and check the GSTR 3B filing status for 1 lakh vendors? This is practically so difficult for a company to comply. Secondly, like I was telling, there could be a case where GSTR 3B has been filed but only partial payment has been made. In such cases, what happens? So, just to reiterate the example that I was giving, liability in suppliers GSTR 1 is 100, liability paid through suppliers GSTR 3B is 70. To the extent of recipient X, who is the recipient in our case, supply has only been made to the extent of 20 rupees. In this case, what does the recipient do? How does the recipient determine how much amount of credit is really available to the recipient? So one thing is that the recipient says that look, the only condition that section 41 and rule 37 is saying that if the supplier is about filing of GSTR 3B, the moment the GSTR 3B is filed, whether full payment has been made, whether partial payment has been made, I don't care. Since GSTR 3B has been filed, I have complied with Rule 37 and therefore I should be eligible for entire credit of 20 rupees. Second, recipient says no, I have to take a more pragmatic approach. Ultimately, the intent of this rule and this section is that if tax has not been paid to the government, entire credit is not taken. So I will do pro rata of the amount that has actually been paid. I know only 70 has been paid. So I will do a pro rata and only to the extent of pro rata of the, so out of 70, I will assume that my amount is proportionate to the amount of only 14 rupees and therefore credit pertaining to 14, only that much will be taken by me. Third, I will be very conservative, which many listed companies are also. They say that look, I do not know the 70 pertains to my supplies, to some other supplies, or what are the calculation behind the 70. I will just assume that the amount of 30 that has not been paid constitutes 20 of mine also, and therefore I will not take any credit at all. So this kind of problem exists as on date. Section 41 has been put into place. Rule 37A has been put into place. But in case of partial payment of tax, how much has to be taken, how much has to be reversed, no mechanism has been prescribed on date. This rule has been inserted in December. 3 months have already been passed, but there has been no clarification to this extent also. Probably in September, when SSCs are really facing this issue and they represent to the government, some clarification may come. But this is an open issue as on date. Second is that they are saying that today you reverse the credit. Tomorrow when the supplier pays, you can re-avail. But section 16.4 prescribes a time limit for availment of credit. If that time limit has passed, will I still be eligible? Will I still be able to re-avail? In other words, whether the time limit prescribed under section 16.4 is only for first availment or it also applies for re-availment. Interestingly, under second proviso section 16, read with rule 37, in that case, they have said that time limit of section 16.4 will not apply in case of re-availment. So, to the extent of that provision, the rule specifically provides that section 16.4 time limit will not apply for re-availment. That kind of provision does not exist under rule 37A. Does that mean that the law deliberately wants to allow in that case and doesn't want to allow in this case? Or is it just an omission by the law? They have not realized that they have put that kind of a provision under, say, Rule 37, but they have not put that kind of a provision under Rule 37A. It is just an omission which will later be inserted. We do not know, but I feel that there is no time limit for reavailment. If you have made your first availment, then Section 16(4) should not apply for reavailment. Another big issue that the assessees are going to face under this section will be interest. They are saying you have to reverse credit along with interest under section 50. Okay. Now I'll go back to the provision so that you understand what I'm trying to say. As we discussed, the substantive provision, which is section 50, is the provision that is governing interest. Every interest flows through section 50 ultimately. And section 50 says that interest will be leviable only in case of ITC wrongly availed and utilized. Both conditions have to be fulfilled. But if you look at Rule 37A, it is only talking about availment. So to this extent, this rule seems contrary to section 53. I'll just read the proviso again. Provided that where the said amount of input tax credit is not reversed by the registered person in a return in form GST 3B on or before the 30th day of November following the end of financial year during which such input tax credit has been availed, such amount shall be payable by the said person along with interest under section 50. Here they are only talking about availment, whereas the main section is talking about both availment and utilization. Secondly, the main rule, Rule 37A, is saying that if GSTR 3B has not been filed the 30th day of September, then you are required to reverse credit by 30th day of November. So from which day do they intend to levy interest? I've made an example for this also to explain this better. On 1st March 2023, I had availed ITC to the extent of 100 rupees. On 1st June 2023, I utilized 70 rupees. Supplier has not filed his GSTR 3B. 30th September has also passed. I realized only in December, after 30th November, after the date which has been prescribed under Rule 37A, on 10th December 2023, I reverse 100 rupees. Now, whether interest will be payable from 30th 11/2023 to 10/12/2023, because 30th 11 was the prescribed day for reversing of credit. So they are saying if credit is not reversed up to 30th November, only in those cases interest should be levied. Or because Rule 37A is only talking about availment, the proviso which is levying interest is only talking about availment. Therefore, interest should be leviable from 1st March, that is the day where the credit has been availed. Or we have to read this section, this rule, along with section 53, which talks about both availment and utilization. And therefore, interest meter will start only from 1st June 2023 to the extent of 70 rupees, because only 70 had been utilized. So this is a problem. This has not been, I think, contemplated or thought through while drafting this provision. So we'll have to see, how the department is interpreting this interest provision. If there is no clarification, or if this provision is not appropriately or suitably amended, then with regards to interest, there definitely will be a lot of litigation. There definitely will be a lot of SCNs issued by the department, and we'll have to see how this moves. So is there any question on this section? This rule, section
Ma'am,
41?
There's one question from Himlata.
So she's asked that from where to check they have filed GSTR 3B in bulk. There is
No.
one functionality and in the GST portal from where you can check, but I'll just check where we can check and I will tell you after this session also specifically. Any other questions? Okay. So moving forward, uh, ITC on employee welfare expenses. Now, this is also an issue which almost all my clients have asked me at least once. Some have asked me twice, some have asked me thrice. Some keep coming back to us month after month after month because there is some EAR that comes on this issue, or there is some new development, some press release, some circular that comes, and everything is again put out of place. Then everybody wants to review their legal position again. So what is the amount that is recoverable from the employee? What is the amount of ITC that can be taken? This is a question that is coming to us again and again. And with slight change in facts, our view is also changing. I understand and I believe that this would be something that many companies would be facing. So therefore, I've picked this up as one of the topics of our discussion today. Now, because this is specifically restricted to ITC, I will first, show the provisions of ITC. But to understand this topic on the whole, I will also talk about the output tax liability in this topic. So, section 17(5)(b) says that input tax credit is blocked on food and beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgery, leasing, renting, or hiring of motor vehicles. However, credit will be available where it is obligatory for an employer to provide the same to employee. So normally credit of food and beverage is restricted, but if some food and beverage or if some canteen facility is being provided to employee due to Factories Act or some other act which makes it mandatory, in those cases credit will be available. There is another proviso, provided that ITC will be available in respect of aforesaid goods or services where it is used for making outward supply of same category of goods or services. So normally credit of a particular service will not be available. So normally credit of renting of hiring of motor vehicle or leasing of motor vehicle will not be available. But if you are using this supply to provide this inward supply to provide same category of outward supply also, then in those cases credit will be available. This is the bare provision. Just for your understanding, I will show examples also so that you understand this provision better. So let us look at the example on the screen. Now there is a company who has hired a canteen contractor and is paying the canteen contractor 100 rupees from his own pocket for providing lunch to its employee. So every employee that who is having lunch in the canteen is let's say the lunch served to him is worth 100 rupees. The employer says that this is a perquisite to the employee. I will not be charging anything from the employee. This is completely on my account. I will bear the entire amount. In this case, first of all, is the employer liable to charge, is the employer liable to pay any GST on the outward side? So many of you all will argue that nothing has been recovered from the employee. Since nothing has been recovered from the employee, therefore, there is no GST liability on the outward side. However, some people will say employer and employer related persons, recovery of consideration is not important as per Schedule 1. Even if no recovery has been made, tax is payable. Then there would be some people who will come back and say that look, there is Schedule 3 which says that services from employee to employer are outside the purview of GST. This plate of 100 rupees is nothing but a part of the salary that has been given to employee in kind. Therefore, there should be no GST on this. So there was a lot of confusion prevailing in the industry on this. In 2022, the government issued circular number 172 dated 6th July 2022, where they clarified that the perquisites provided by the employer to employee in terms of employment contract will not be leviable to GST. So after the circular, as far as outward side is concerned, in the particular example at hand, it is very clear that in such a case, no GST is chargeable on outward side. This 100 rupee will be considered as a perquisite. So as far as recovery on the outward side is concerned, we are covered. No GST has to be paid. Okay. Now let us go back to the inward side. I have paid 100 rupees plus 5 rupees on account of GST to canteen contractor. Can I avail ITC of this 5 rupee? Let's go back to the provision. The provision says ITC of food and beverages and outdoor catering is blocked. ITC will only be available where it is obligatory for an employer to provide the same to his employee. Accordingly, if canteen is being provided out of some compulsion of law as per Factories Act or something else, in those cases credit will be available. In other cases, credit will not be available. I hope everybody is clear on this. Coming to the second situation, which is more tricky. In this case, what happens is the employer is paying 100 rupee per plate to the canteen contractor, but is recovering 10 rupee from the employee. So a subsidized or nominal recovery is made from the employee. So employer is bearing 90 rupees, employee is bearing 10 rupees. In this case, what happens? So interestingly, relying on the first example or first situation and the above circular, there are more than 5 AARs which are saying that even in case some recovery is being made, this is still a perquisite as termed in terms of circular number 172, and therefore no GST on the outward side. And though there are very few AARs which are actually pronounced in favor of the assessees, and this is a matter of joy to the assessees that a favorable AAR has been pronounced in this case. But the logic of the AR is doubtful. Not sure how the upper forums will hold on this issue. It is very much possible to say that to the extent of 10 rupee recovered, GST should be paid. So there is a confusion prevailing on this as to whether the circular will apply to these cases also, or whether in cases of recovery, whatever amount of recovery has been made, tax is payable. Let us for a second assume that on this rupee 10, GST is payable. So employer is paying GST at the rate of 5% as per the rate notification on this 10 rupee. Now, here it is important to note that the notification which is providing 5% GST rate on canteen services specifically says that input tax credit cannot be taken. Therefore, I am of the view that to the extent of recovery made and GST paid on at the rate of 5% to the extent of the recovery, even if it is obligated and there is no restriction posed by section 17, there is an independent restriction that has been posed by the rate notification, and therefore credit cannot be taken to the extent of 10 rupee at least. Now here what the confusion is that whether the entire credit of GST paid on 100 will be denied, or whether 90 can still be considered as perquisite only on the extent of 10 rupee which is being recovered from employer, only to that extent on inward side credit should be denied. So there are two schools of thought on this. One school of thought is that the entire services that has been received by the employer from the canteen contractor is being given to the employee. Only the value has changed. Therefore, no credit should be available to the employer because the entire services has been used to provide services to employee. And as per rate notification, credit has been denied. Second school of thought is that to the extent of 10 rupee only services have been provided to the employee. So to the extent of 10 rupee only credit should be denied. Remaining 90 should be considered as a perquisite. And the view taken in example 1 should also be applicable here. To the extent of 90, rate notification will not apply at all. Only section 17 will apply. And therefore, if it is obligatory, in those cases to the extent of 90, credit will be available. There are very many ARs with every kind of decision that has been given on this issue. Okay. So you will come across every possible situation and every possible answer in every possible AR. Any questions on this? I am taking another example on transportation also in case of employee recovery. So I'll go forward to the transportation situation. In transportation situation, what is happening is that there is no restriction of rate notification. So rate notification is not restricting credit in case of transportation. Okay. So we only have to look at section 17(5) as far as transportation is concerned. So what is happening is that I am taking transportation services from, I as an employer, I'm taking transportation services from a transportation contractor and providing transportation to the employee. Whether credit will be available or not on the GST amount paid to the transportation contractor is the question in this case. Here, as I just explained, we only have to look at section 17(5)(b). Okay. Now, section 17(5)(b) is restricting credit on leasing and renting of or hiring of motor vehicles. Here it has to be noted that motor vehicle in this case has been defined under GST to only mean motor vehicles which have seating capacity of 13 or less. So if it is a bus with a seating capacity of 40-50 people, which the company is plying, in those cases there is no restriction of credit at all and credit will be available in all cases. Therefore, if there is a vehicle with seating capacity of more than 13 people, all this has not to be seen at all. You can just take the credit. However, if there is a small vehicle which is being used, which is being taken by a supplier and then being given to the employee for the transportation of the employee, in that case, what happens, we'll have to see. Now, if there is no recovery, entire amount is being borne by the employer, employee is not paying anything, and this amount is not obligatory and under any law. In that case, we say that as per circular 172, this is merely a perquisite that is being provided to employee. There is no outward supply in this case. Since there is no outward supply, we only have to look at section 17(5)(b), which is restricting the credit, and therefore credit cannot be taken. Second case is where employer is bearing 90 and employee is bearing 10. In this case, like I discussed in the canteen example, GST may become payable on 10 rupee. If seating capacity is more than 13, then there is no problem at all. Credit was always available. If seating capacity is less than 13 persons and you have recovered GST on the outward side only on 10, then we have to look at the second proviso. The second proviso says that provided that ITC will be available in respect of aforesaid goods or services, where it is used for making an outward supply of same category of goods or services. So you have taken something on inward side and you are also providing services to the extent of 10 rupees on the outward side. So to the extent of 10 rupees, input tax credit will be available. For the remaining 90, credit will only be available if it is obligatory for employer. If it is not obligatory for employer, credit will not be available. I'm sorry if it sounds very confusing, but with small change in facts, views are changing in this case. So in all of these cases, section 17 has to be analyzed Both the provisos have to be analyzed. Rate notification has to be analyzed along with circular number 172. So Shweta has asked, insurance paid by employer on behalf of employee, can GST be claimed? Similar only. So if you look at section 17 as per my presentation, sorry. So if you look at section 17 as per my presentation, ITC is restricted on insurance as well. Okay. So in case of insurance also, credit cannot be taken. Sorry. So as far as insurance is concerned, let's say I have taken insurance for all my employees. As per circular 172, it is qualifying as a perquisite and I am not recovering anything from the employees. So outward side, there is no tax that is payable. As per section 17, credit on insurance is blocked. Therefore, credit will not be available. Credit cannot be taken. However, if some recovery is being made and we say that outward side similar services are being provided, then as per the second proviso that we just discussed for transportation services, to the extent of the amount on which GST is paid on the outward side, credit can also be taken on the inward side. If it is obligatory for employee, then credit can be taken, correct. But as far as insurance is concerned, I have not seen any case, I have not seen any law where insurance for employee has been made obligatory. Ma'am, is this 100 rupee inclusive of GST? So now this is also another problem. There are case laws under pre-GST regime which say that until and unless it has specifically been provided that the amount collected is inclusive of GST, it cannot be assumed that the amount collected is inclusive of GST. So a contract between supplier and recipient specifically has to provide that this amount is inclusive of GST. If that is not being provided, then an assumption or a presumption is made that that amount is exclusive of GST. So inward supplies is nothing but supplies taken by the employer from a vendor. So what has been taken by an employer from a vendor is an inward supply. Outward is supplies provided from the supplier to its employee. So chartered accountant, a chartered accountant is giving chartered accountant services. That is the outward supply of the chartered accountant. He is taking an office premise on rent, that is an inward supply. He is taking telephone services, courier services, all of that are inward supplies. In case of employee recovery, whatever supplies is being received by the employer from the vendor is an inward supply. Whatever is being provided by the employer to the employee, if any recovery is being made, then that qualifies as an outward supply on which GST is payable. This concept is actually very confusing. And over the years, as and when some decision has come or as and when some circular has come, views have rapidly evolved and changed also. Okay. So you'll have to just see that. In case of employee recovery, what my suggestion is that you first analyze on the outward leg whether some GST is payable or not. So you first analyze circular 172 and you see that whether it is a circular, whether it is a perquisite being provided or whether some recovery is being made. If it is a perquisite without any recovery, then there is no GST that has to be collected by the employer from the employee. However, if some recovery is being made, then whether GST is paid on that or not, that you determine. Once whether GST is being charged on the outward side by the employer has been determined, then you go back to the leg of availing input tax credit. Then you determine whether ITC has to be availed or not. Then you go to section 17(5)(b) and first see whether there is any restriction or not. If there is no restriction, then no problem at all. If there is some restriction, then you check whether it is obligatory or not. If it is obligatory, then credit will be available. If it is not obligatory, you can go to the next proviso and see if you're providing outward supplies of the same category. To the extent outward supplies are being provided and some amount is being collected from the employee, credit will be available to the employer. Is what I'm trying to say in a nutshell. If you still have any questions, specific questions, I will be happy to answer after the session. Khushbu has specifically given one question in the Q&A box which says whether company is eligible to take credit on gifts provided to the employees. So the law specifically provides to the extent of 50,000 rupees, whatever gift is being provided to the employee, there is no problem. Over and above 50,000 rupees, there is a problem. So what is happening is that, first of all, there is section 17(5)(h), which says that credit will not be available on gifts. So section 17(5)(h) itself is restricting credit on gifts. So as per section 17(5)(h), credit will not be available if any gift is being provided to any employee. In fact, gifts provided to any dealer and anybody else, I will come to the section of gifts also. But section 17 of the CGST Act specifically restricts or denies credit on any gifts given to anybody. So in all of those cases, credit will not be available. Any other questions on employee recovery? Shares provided by companies for promotion to employees to wear on some specific events. Can credit be availed on this? Pooja, I will come to this question. I have another slide on a similar topic. When I'm addressing that topic, once I'm done explaining that, I will talk on this as well. So the next topic is ITC on sales promotion items. Now, section 17(5)(h) of the CGST Act says that input tax credit will not be available on goods lost, stolen, destroyed, written off, or disposed of by way of gift or free samples. So any goods that have been gifted, input tax credit under section 17(5)(h) has specifically been blocked. Now the problem is the term gift has not been defined under the GST Act. So what really constitutes gift? There are various jurisprudence on this in the international law under UK VAT. There is a press release under GST also that has been given by the government. Then there is a Transfer of Property Act which defines gift. We have looked at all of that. Section 122 of the Transfer Property Act defines gift as transfer of existing movable or immovable property made voluntarily and without any consideration. Then press release of CBIC also explains gift, which says that gift as understood in common parlance is made without consideration, voluntarily and occasionally. Overall, on an analysis of the various jurisprudence that is available, we understand that gift is something that is made voluntarily by the supplier to the recipient. It is not flowing out of some contract. Supplier is not benefiting from the gift that is being made to the recipient. It is not like supplier is also benefiting. The thing that is given by the supplier to the recipient should have some economic value to the recipient. If it does not have any economic value to the recipient, it will not qualify as gift at all. And this act of giving something from supplier and to recipient should be without any consideration. That is, nothing is flowing back to the supplier. That is what we understand. Now, let us look at different situations. First situation that I have taken is that there are many companies that they are saying to their dealers, distributors, employees, sales representatives, MRs, they are saying that if you are able to sell this much quantity of my goods, I promise you a trip to Singapore. So for that trip to Singapore, I am availing services from a travel agent, say Cox and Kings. So whether the company will be eligible to input tax credit of the GST paid to the travel operator, or whether that will qualify as a gift. In this regard, it has to be specifically noted that section 17.5H is only applicable to goods. Goods lost, goods stolen, goods given as gift. So they are not talking about services at all. Since this tour operator service is merely in the nature of service and is being given to dealers to incentivize them to sell more of my goods, we feel that it is in the course of furtherance of business. Therefore, it should be available under section 16, and there is no restriction of credit under section 17.5H also. Then next situation is that pens, diaries, caps, calendars, and other small value items are given through dealer, distributor, employee. In those cases, whether credit will be available. Many times, what happens that on these items, the logo of the company is also printed. So there are two schools of thoughts over here. First is that all of this is given to dealers, to distributors, to retailers to only increase the brand visibility of the employer. This is nothing but something in the nature of sales promotion activity to increase the sale of the supplier, and therefore credit should be available. The second school of thought is that no, maybe your brand or your logo is present, but this is something that is being given to dealers, distributors on occasions such as Diwali, Holi. This is not really linked to completion of some targets or etc. Since this is a voluntary item that is being given by the company to a dealer, to employee, or to a distributor during some festival, this really qualifies as gift. This is not a sale promotion item and credit will not be eligible. The third is catalogs, leaflets, signboards, etc. Whether credit on such items will be available or not. Here I am of the view that what these kind of items which are given to employees or to dealers, distributors, retailers, these really merely qualify, do not have any economic value in the hands of the recipient. The recipient cannot derive any economic benefit out of that individually. It is not really benefiting the recipient as such. It is only benefiting the supplier. So in that case, it is not a gift and credit cannot be denied. In the case of signboards, you must have seen that there are many companies which give signboards to the retailers where the logo of the company is also displayed, and along with that the name of the retailer is also given. So Jagannath Stores, Jagannath Enterprises, something like that is written on the signboard. In those cases, it can still be one school of thought still could be that there is some commercial value attached to this that is given by the dealer to the recipient. In those cases, it can still be said it is a gift and credit could be denied. But in most other cases, there is no economic value to the recipient, therefore it should not qualify as a gift and therefore credit should not be denied. These are only expenses that have been incurred by the supplier or the company to increase the brand visibility, to increase the sales promotion, to show people their items, products, and therefore credit should be available. Then somebody asked about uniforms in the question. If so, again with uniform also, uh, there is a lot of confusion. So if a uniform is given to an employee, which the employee is compulsorily required to wear every day during their employment, if the uniform has a logo of the company and which shows that the employee is a representative of the company, we are of the view that this uniform is being worn by the employee only in the course of furtherance of business of the employer. This is a part of the employment service and this is a condition to the employment that you have to do some things like this. You have to work on the laptop given by the company. You have to wear the uniform that is given by the company. This is not really a gift to the employee because it has there is a condition attached to it that it has to be worn every day to work. So in those cases, we are of the view that it is not a gift and ITC should be available. Having said that, sometimes what happens is that companies taking employees on a picnic or on an annual retreat, in those cases, they give some t-shirts, etc. to employees with logo of the company and all. In those cases, it is quite possible to argue that shirts given to employee in such cases are merely in the nature of gifts. There is no condition attached to it. Employees are not really required to wear it to work every day. This is in the nature of gift only, and credit will be denied. Okay. There is another question. Thanks for the reply. But if gift is provided for the services rendered by the employees, for example, not all employees are given gifts. According to the performance and rating, different gifts have been provided. So in this case, whether credit will be available. So supposing there is a company which is giving an Employee of the Month award. Employee of the Month award is 2 gold coins. So whoever is the Employee of the Month is giving gold coins. We are of the view that this will very much qualify as gift only and credit should not be taken. Can gift exceeding 50K be treated as supply? So here we have to look at section 17.5H along with schedule 1. So section 17.5H says that if something is a gift, credit has to be reversed. So if credit has been reversed, then there is no question of treating it as a supply on the outward side. However, if something is not treated as a gift and is not restricted by 17.5H, in that case we have to come to schedule 1. That is, in such cases input tax credit has been retained. Then schedule 1 says that in case of permanent disposal of business assets on which credit has been taken, GST has to be paid. In those cases where it is not supplying as gift, not qualifying as gift, but the value of the assets that are being disposed is greater than 50,000 rupees, in those cases, even though credit can be taken, however, Schedule 1, Clause 1 will be attracted. And in those cases, if credit is taken, then any gifts, any items which have a value of over 50,000 rupees, tax has to be discharged on the outward side. Nilesh Rohani has written, can catering service provider charge 5% even when he is not in composition scheme without ITC? Nilesh, if you look at the rate notification, in case of restaurant services, in case of outdoor catering services, the rate prescribed by the notification itself is 5%. You do not have the option of paying GST on a higher rate at all. So you are compulsorily required to pay GST at the rate of 5% without taking any input tax credit. This is not due to any composition scheme that the catering service providers are charging GST at 5%, but it is due to the rate notification itself that GST is being paid at 5%. Okay, so I'll just move forward to the next topic. Okay, so one last situation over here. A gift received by redemption of loyalty points. So many a time what happens is that we tell the dealers that on every 100 items, 100 quantity of a particular item that you pick up, you get 10 loyalty points and so on and so forth. And on accumulation of loyalty points, say 1,000 loyalty points have been accumulated, the dealer will be eligible to use the loyalty points to purchase something from the employer, also from the company. In those cases, whether credit will be available. We are of the view that those cases do not qualify as gifts. The price of these items that will be given vis-a-vis the loyalty points have already been factored into the price of the original items being supplied to the dealers or the distributors. This is just a marketing gimmick. This is not really a gift. It is attached. There is an attached condition that you have to lift so many quantity, then you will get this much loyalty points, which will be used to purchase something from the employer. In these cases, we are of the view that this is not a gift. Credit should definitely be available. Any questions here? Okay, I'll move on to the next topic. ITC on assignment of leasehold rights in land or leasing of land. Now, this is something that many companies are facing today. In the last 1 year, I have given more than 20 opinions on this issue, because of which I have picked this up as an item of discussion in our current webinar. So what is happening is that many companies are taking a land on lease from from government, from development authorities. So there could be two situations. First situation is that the land is directly being taken on lease from the government, on which the government is charging GST. So land is taken on lease from MIDC or from SIDCO or from Ahmedabad Urban Development Authority or Noida Urban Development Authority. They have charged GST and you have paid GST. It is a separate issue that GST may not be payable at all because it is exempt and all. For the purpose of the current discussion, we are assuming that GST is payable. In those cases, whether ITC of such GST paid will be available or not is the question. Second situation is that Mr. A had taken this land on lease from MIDC, but now for 100 years. But after 20 years, Mr. A no longer leases this land. So he is assigning leasehold rights in the land to Mr. B. And an assignment of leasehold rights in the land, Mr. B is paying GST to Mr. A. Whether input tax credit in this case will be available or not. In this respect, there could be a situation where the land which is being leased out or is being assigned to the recipient already has a building constructed on it and there is no fresh construction that is being carried out. There could be a case where it's a barren land and the person who has taken this land on lease will be constructing a new building. There could also be a case that a building is already erect or constructed, but the recipient does not require that building. So he will first demolish that building and construct a new building on the land. So whether input tax credit would be available. In this regard, it is pertinent to analyze Section 17(5)(c) and D of CGST Act, which says that input tax credit shall not be eligible. I would actually read the exact provision for you. 1 second. It says that input tax credit shall not be eligible in respect of works contract services when supplied for construction or goods or services or both received by a taxable person for construction of an immovable property. Basically, what section 17(5)(c) and D are saying is that any works contract services or any goods and services received which are being used for construction of an immovable property, input tax credit will be denied. Now here a question arises that whether only those goods and services which are directly linked to construction activity, for that credit should be denied, that is cement, bricks, all of that which is being purchased, interior decorator services, construction contractor services, manpower services, credit of only those things should be denied, or whether something as indirect as leasing services also credit can be denied. So going back to this provision, it says works contract services when supplied for construction, goods or services or both received by a taxable person for construction. So here the word that the operative word that has to be analyzed is the word for. Now there are two types of judgment which analyze the word for in the pre-GST law. Some say that for is of wide import and anything direct or indirect, both shall be included in the ambit of the term for. In this regard, there is one judgment of the Supreme Court. I will just... there is one judgment of the Supreme Court in the pre-GST excise regime in the case of Tata Engineering and Locomotives Limited. And there is another judgment of the Supreme Court in the case of there is another judgment of the Supreme Court. There, the words written were used for manufacture. So there, the Supreme Court had held that used for manufacture means directly or indirectly used for manufacture. For means directly used for manufacture, indirectly used for manufacture. Everything will be covered. So as per that judgment, for was a wide import. Then there was another judgment which interpreted for to be of a very narrow import and said that it has to be directly used for something. Only then it will be covered under the term for. Therefore, in case GST is being paid today by the supplier and being charged to the recipient, it becomes imperative to understand and analyze whether recipient will be eligible for the credit in such cases. Because in case of leasing of land or assignment of leasehold rights in land, the amount is huge. These are not small amounts, but these are huge amounts. So like I already explained, there could be a situation where there is a building structure that is being demolished and a few new factory building is being constructed. In that case, if a conservative view has to be adopted, then it has to be said that this leasing activity is ultimately for construction of a new building for which credit has been denied under section 17(5)(d), and therefore credit will not be eligible. Then second situation is construct a new building on existing empty space. Construction of new building on a certain portion of leasehold land. So I have taken 100 acres of land. I am constructing building only on 10 acres. So in such cases, a view can be taken that for the remaining 90 acres where no construction is taking place at all, section 17(5)(d) should not apply. And to the extent of 90 acres, so at least credit should be taken. To the extent of 10 acres, this argument can be taken that it is not directly used for construction activity, and therefore section 17(5)(d) should not be applicable. Or alternatively, a conservative view can be taken that for the word for is of wide import, and therefore even leasing should be covered under services used for construction, and therefore credit should not be available. So to the extent of the 10 acres, there is this dispute whether credit should be available or not. But as far as this 90 acres is concerned, credit should be available. Similarly, this restriction of credit under section 17(5)(c) and D is for immovable property, but the term immovable property excludes plant and machinery. So the portion of land which is used for construction of an immovable plant and machinery, also credit should be available in my view. Then there is a third situation where there is a building that has already been constructed. I am not undertaking a new construction, but only some repairs. In such a case, I am of the view if only some repairs activity is being undertaken and no new construction of building is being undertaken, credit on leasing activity cannot be denied. However, as far as the repair activity itself is concerned, the cement, the bricks that are being used for repairs, on that whether credit will be available or not, we have to check whether the cement, brick and all of these repaired expenses, whether they are being capitalized or not. If expenses is being capitalized, then credit will not be available on the cement and brick. But if the credit is not being capitalized, if the expense is not being capitalized, then credit will very much be available. So Payal is saying, please cover most important slides as time is running out. But I would like to tell Payal that only one topic is left. I have planned my slides in such a way that everything is getting completed in 2
Thank
hours.
you.
Please don't worry.
Thank you, sir.
Any questions on this issue of assignment of leasehold rights in land? Is there anybody who's facing this issue currently? Whether GST is payable on outward side, whether ITC can be taken? We've recently filed a representation before the GST Council also on this issue. Because there were some 2,000 small MSMEs who had not paid GST on this transaction. So they were getting hit by this. Okay. So moving on to the last topic of my presentation. This is whether ITC can be used to make pre-deposits under GST and under the erstwhile law. So there are two aspects to this. First is that there was some credit in the pre-GST law that has been transitioned into the GST regime. Now there is some litigation that has come under the pre-GST law, and I have to do some pre-deposits. In that case, whether ITC can be used, whether ITC which is now there under GST, whether that can be used to make pre-deposit under the pre-GST law. Here, please note that there is a specific circular that has come out in 2022, which specifically says that ITC pertaining to the GST law cannot be used to make pre-deposits in the pre-GST law. Therefore, pre-deposit in the pre-GST law specifically have to be made with cash only. As far as GST is concerned, there was one negative judgment in the case of Jyoti Construction, which disallowed the use of electronic credit ledger for making pre-deposits. There, the contention of the court or the observation of the court was that the credit in the electronic credit ledger can only be made to discharge output tax liability, and pre-deposit, not being a crystallized output tax liability, cannot be made through input tax credit or through electronic credit ledger. However, thereafter, there are two positive judgments in this regard in the case of Tulsi Ram and Company and Oasis Reality, where they have allowed the use of electronic credit ledger for mandatory payment of pre-deposit. Also, the form in which pre-deposit has to be made, that is form APL01. In that, there is a drop-down which is specifically allowing payment of pre-deposit through electronic credit ledger. So we are of the view that as far as GST is concerned, payment of pre-deposit can be made through electronic credit ledger also. With this, I come to the end of my presentation. You can note down my email ID and my phone number. In case of any queries on any aspect, please feel free to reach out to me and I will answer.
Nivedita ma'am, so from your end, the presentation was wonderful. Like I too had 2-3 disputed points which got covered in this session. And on behalf of this WOW series team, Women for Wednesdays, I take pleasure to propose a vote of thanks to you. And you have indeed put a lot of efforts for this webinar. I can see a lot of case laws and all. I have noted down each and every case law, but it would be very nice if you can provide presentation so that we can use it for the later use. I think many of the participants have asked for this presentation. If you can email to WRC, they can forward to the participants.
I will definitely share the presentation with you so that you can share with the participants.
So wonderfully, the case laws have been presented, and it will be very helpful for us in closing down for 31st, although we know it's only one day and it's very difficult to find out right now, like, but then still we have time till November, when we can decide whether we can do the reversals and all. And we are very enlightened with the presentation, and thank you so much. Any other points any participants want to ask? They can email the questions to ma'am. She has already given. We can end the meeting here. Thank you so much. Have a great evening. Bye.
Thank you so much, Payal. Appreciate.